First time in history, gold closes above $5,000 weekly. Russia says no to dollar return. Not an intraday spike, not a flash move, a weekly close. Bloomberg published a story Thursday that moved markets worldwide. Russia's central bank chief called it fabricated. Zero involvement, zero talks. While that was happening, China just banned something that's held the entire system together for decades. Physical delivery, now enforced. Rehypothecation, finished. Paper multiplication, over. 9.6 trillion in US debt matures in the next 12 months. Gold ETF holdings are falling while price triples. And central banks, they're not selling. What just broke? Welcome to OW and AG. If you followed monetary systems long enough to remember when currency actually meant something, then you know this channel exists for a reason. We'd be honored if you'd subscribe. Serious analysis deserves serious attention. And tell us, where are you watching from today? What part of the world are you observing this unfold from? Now, let's break down exactly what just happened. On the final trading day of the week, something occurred that had never happened before in the entire history of gold markets. The metal closed above $5,000 per ounce on the weekly chart, not as a momentary spike, but as a confirmed weekly settlement price. This distinction matters more than most realize. When analysts examine gold movements, they separate noise from signal by studying closing prices rather than intraday fluctuations. It reflects where the market genuinely settled, not where it briefly visited. A weekly close represents the consensus valuation after 5 full days of global trading, after every hedge fund and central bank has made their final positioning decisions. That week just ended. As this historic close was recorded, Western spot markets showed gold at $5,040. Meanwhile, in Shanghai, prices created a significant premium. This divergence is a diagnostic tool for understanding where physical metal actually exists versus paper contracts. This content is for educational purposes only and is not financial advice. Welcome back to The Silver Truth. Today, we're decoding a major manipulation attempt that moved billions. Silver showed a $9 premium in Shanghai versus Western markets, a dramatic separation that's widening fast. But the real story is how financial information itself is being weaponized to suppress these historic price levels. Bloomberg claimed Russia was returning to the dollar system. It was a complete fabrication that triggered immediate selling. The Russian central bank confirmed zero involvement. This was market manipulation via a major news outlet. Yet, gold still managed its first ever weekly close above $5,000, overcoming the disinformation. The systemic forces driving this market are now too strong for coordinated media manipulation to stop. Subscribe for unfiltered intelligence. This is for education, not financial advice. See you in the next deep dive. Welcome to The Silver Truth, where we don't just report market movements, we decode the strategic forces behind them. While Western media focused on fabricated Russia headlines, something far more consequential was unfolding 8,000 miles away. China had just announced regulatory changes that would fundamentally alter how precious metals could be traded within their borders. These were not minor policy adjustments. These were structural rules. Second, physical delivery is now mandatory on all settlements. No more cash alternatives. Actual metal must change hands, or the contract is void. Most significantly, rehypothecation is finished. This mechanism allowed 1 ounce of physical gold to generate multiple paper claims, suppressing prices for years. The impact is immediate. Shanghai silver holdings stood at 11 million ounces, with only a tiny fraction added last Friday, barely enough to meet delivery obligations. The game has changed. Stay vigilant and subscribe to The Silver Truth for more unfiltered economic intelligence. Disclaimer: this is for educational purposes only. Even more revealing was the price behavior within China's own market structure. The Shanghai Futures Exchange was trading silver at a premium over the Shanghai Gold Exchange spot price. Not a small premium, a $2.31 premium. This internal Chinese arbitrage spread indicated that even within their own borders, physical metal was becoming difficult to source at the speed required to meet delivery obligations. When futures trade above spot within the same country's market system, it signals physical shortage stress. Normally, futures trade at a slight premium to spot due to carrying costs. But when that premium widens significantly, it reveals that market participants are willing to pay extra for guaranteed future delivery because they doubt their ability to source physical metal. China produces only 13% of the world's silver through mining operations, yet they control 70% of global refined silver supply. This distinction is critical. Raw silver ore coming out of the ground is economically useless until it goes through refining processes that purify it to the standards required for industrial applications. China had spent 2 decades building the refining infrastructure that turned raw material into usable metal. They now controlled the processing bottleneck. This meant that even countries with significant silver mining operations remained dependent on Chinese refining capacity to convert that ore into deliverable metal. The mining advantage was meaningless without the processing advantage. Western markets were about to discover what happened when paper promises met physical scarcity. While China restructured precious metals markets and Russia publicly rejected dollar integration, a mathematical crisis was accelerating inside the United States Treasury. This is the silver truth. The Treasury needs to roll $9.6 trillion in maturing debt while funding new deficits. That's $11 trillion in total bond purchases needed in just 12 months. This creates refinancing risk. If bond demand weakens, interest rates will spike, creating a feedback loop with no natural stopping point. Yet, physical gold ETF holdings are declining even as gold hits $5,000. The total physical gold in ETFs is lower than when it was at 1900. The mechanism is breaking. Subscribe to the Silver Truth for more unfiltered intelligence. This is for educational purposes only. Stay sharp. Welcome to the Silver Truth, where we decode the strategic forces behind the market. Today, we're looking at a pattern that violates all normal speculation. While gold soared from 1900 to 5000, ETF holdings were actually falling. Retail investors were selling while prices climbed. But someone was buying. Central bank gold purchases hit a 50-year high as sovereign institutions accumulated physical metal directly. Now, analyst David Morgan warns of a strategic silver stockpile. The US produces only 13% of its silver, but needs it for military and AI systems. Most critical, China controls 70% of silver refining. Without access, modern American technological and military power is at risk. This isn't just a market cycle. It's a monetary phase transition. The pressure is building. Stay tuned to the Silver Truth for more unfiltered intelligence. Russia's central bank governor just sent a direct signal. Zero involvement in dollar return discussions. This isn't just a denial, it's the final welding shut of a door Bloomberg claimed was open. Russia has committed to a multipolar monetary architecture, moving decisively away from dollar hegemony. This narrative manipulation attempt occurred exactly as gold breached the historic $5,000 mark, showing how media is being weaponized at critical technical moments. But the physical reality is undeniable. We are seeing a massive decoupling. As Shanghai silver holds a $9 premium over Western paper markets, with mandatory physical delivery in the East and inventory draining fast. The paper illusion in the West is reaching its limit. Central banks are stacking physical metal at record rates, ignoring the paper noise. The game hasn't just changed. The board has been flipped. This is the Silver Truth. Stay vigilant. Subscribe for strategic intelligence. We'll see you in the next analysis. Welcome to the Silver Truth, where we don't just report market movements, we decode the strategic forces behind them. Gold has printed its first weekly close above 5,000 in history. This distribution was the opposite of speculative excess. Bubbles required crowd participation. They featured retail enthusiasm and media celebration of easy profits. None of those were present. Instead, the most sophisticated players in global markets, central banks with unlimited research budgets, were accumulating aggressively while conventional investors sold. Bloomberg's fake news moved markets Thursday but did not break them. Russia denying dollar talks did not immediately force a dollar collapse, despite the headlines. China banned rehypothecation and enforced physical delivery, eliminating the paper multiplication mechanism that had suppressed metals for decades. The 9.6 trillion debt maturity over 12 months is an unprecedented refinancing risk during a deficit crisis. The debt spiral is accelerating. The monetary system is not approaching a potential crisis. It was already inside one. The only question is whether you recognize the phase transition while there is still time.